Here is a comprehensive problem on Treasury stock. So we're going to record multiple purchases of Treasury stock, and then we'll sell it, and we'll end up retiring some as well. So in number 1, we purchased 80,000 shares of $1 par value common stock on the open market for $2.50 a share. So what we're going to do is debit Treasury stock and credit cash. And you'll recall that Treasury stock is a contra shareholders equity account, and we're buying 80,000 shares at $2.50 a share, so that's its cost basis, and that would be $200,000. We made a second purchase of Treasury stock where we bought 16,000 shares of common stock at $2.80 a share. So again, we're going to debit Treasury stock and credit cash, but in this case it's for 16,000 shares and it has a different cost basis of $2.80 a share. So 16,000 shares times 280 is 44,800. And what was that credit? Oh, you got it, cash. So credit cash for the 44,800. So we sell 44,000 shares that we purchased in number 1 for 131,000. So we're going to debit cash because we sold it for 131,000. We're going to credit Treasury stock, and I'm going to abbreviate TS, for 44,000 shares times its cost. And in number 1, the cost was $2.50. So 44,000 shares times $2.50 happens to be $110,000. So it appears we sold it for more than what we purchased it for, and who comes to your rescue but paid-in capital, Treasury stock, for the difference. And the difference is $21,000. We sold the other 36,000, so the remaining first purchase, for 72,000. So we're going to debit cash for 72,000. We're going to skip a line, and we're going to credit Treasury stock. Well, maybe we'll skip 2 lines. Treasury stock for 36,000 times its cost basis, which is $2.50. So 36,000 times 250 is a total of $90,000. And we said that what we use first to compensate for this difference is the paid-in capital Treasury stock. So we're going to be debiting paid-in capital for the Treasury stock for the difference, which is 18,000. So notice we have enough paid-in capital Treasury stock to take care of selling the Treasury stock for less than the $2.50 we bought it for. Continuing on, you'll remember that in number 2, we purchased 16,000 shares of Treasury stock at $2.80. So the 5th entry is that we sold 6,000 of those 16,000 shares for $1.60 a share. So we're going to debit cash for 6,000 shares times $1.60 a share, because that's what we sold it for. And so that would be $9,600. We're going to credit Treasury stock for 6,000 shares but remember its basis was $2.80, what we purchased it for, and 6,000 shares times 280 is 16,800. Now we have a bit of paid-in capital treasury stock left because we have the difference between the 21 and the 18. So the amount of balance that we have in paid-in capital treasury stock is $3,000, the difference between the 18 and the 21, which is $3,000 balance. So the first thing we're going to do is debit paid-in capital treasury stock to bring that account balance down to 0. Now, this still doesn't balance, and so who comes to your ultimate rescue but retained earnings? So retained earnings is going to be debited for the difference, or $4,200. So now that sale of the second purchase of treasury stock for less than what you acquired it for balances. In number 6, we're going to retire all the remaining shares. So the remaining shares are, we have 10,000 shares that cost us $2.80. So the first thing we're going to do is we're going to credit treasury stock for those 10,000 shares at $2.80. And when we retire, we don't get any money or anything. We're just going to retire the stock. Also, if there was paid-in capital still on that treasury stock, we would debit the remaining balance to get rid of it. But the other thing we have to do is, if we're retiring the common stock, we need to eliminate or shred that common stock and its IPO pink. So common stock, we have 10,000 shares. And remember, common stock is always at its par value, and its par value is $1. So we will debit common stock for $10,000. We also need to get rid of its initial pink, or paid-in capital. And so when we had that IPO, we initially sold those 10,000 shares at $1.50 a share. So we sold it for 50 cents above its par value. So I need to eliminate that initial pink because we're retiring the stock from that IPO. So have we eliminated the stock, the common stock, and the treasury stock, and then we take a look at this entry and say, does it balance? Well, I've got debits of $15,000 and credits of $28,000, so I need another debit of $13,000. And who is our ultimate helper to make sure that this all comes out right? It's retained earnings. So we're going to debit retained earnings for the difference. The final question is, what is the reasoning behind treating the purchase of treasury stock as a reduction of shareholders' equity as opposed to treating it as an investment asset? Well, treasury stock is self-ownership, and all ownership is in shareholders' equity. So if we choose to be our own shareholder, then it needs to go in our ownership section, not in a third-party transaction, as it would be as if it was an asset. So, hope this helped.